All right, think about your pantry, your freezer, maybe even your snack drawer right now. Chances are you've got something in there from the company we're diving into today. Conagra Brands. We're talking about names you definitely know, like Bird's Eye, Duncan Hines, Healthy Choice, and yeah, even Slim Jim. So the big question for you is, how does a food giant like this, one that's been around for over 100 years, how do they adapt and, thrive in today's market? It's super competitive, things change fast.
That's exactly what we're digging into. And for this deep dive, we're pulling directly from Conagra Brands' latest 10K annual filing. It's from May 2025, so it gives us a really fresh look, updated as of July 10th, 2025.
Yeah, about as current as you can get.
Pretty much.
So our mission here is to give you a shortcut, basically, to getting smart about this major player in the food world. We want to pull out the surprising stuff, the key insights, really understand how a company this big actually works, how they handle challenges, and what they're planning next. So maybe let's start with the basics. Who is Conagra Brands, really? You've probably seen the name, but there's a bit of a story. They're headquartered in Chicago, Illinois, stock ticker CAG on the New York Stock Exchange. And what's really interesting is the history. Over 100 years old. Started way back in 1919, believe it or not, as a flour milling company in Nebraska.
Yeah, quite the journey.
Then they reincorporated in Delaware in 76. And, they've completely transformed into this branded, consumer packaged goods food company we see today.
What's fascinating, I think, is how they talk about it. They describe this journey as becoming a pure play food company.
Pure play. What does that actually mean in this context?
It's a strategic thing. Basically means they're shedding stuff that isn't core food products. They're focusing intensely, betting everything on just food. It signals they want to dominate specific food categories rather than being a sprawling conglomerate with fingers and lots of different pies, so to speak. It often happens when mature companies want to get more agile, sharpen their focus on what people actually want to buy and eat now. Their portfolio's constantly shifting to meet those tastes. Just think about the range of brands: Marie Callender's Reddi-wip, Angie's Boonsi Chicka Pop. It's a huge spread.
Okay, so if they're pure play food but still have all these different brands, how do they organize that? Like, how do you manage frozen vegetables and microwave meals and popcorn all under one roof?
Right, it's complex. They manage it by breaking the business down into 4 main reporting segments. Helps them keep track and strategize for each part. First, you've got grocery and snacks. This is mostly your shelf-stable stuff. Think canned goods, baking mixes, snacks, sold through regular retail stores in the U.S.
Okay, like Duncan Hines, Slim Jim probably fall in there.
Exactly. Then there's refrigerated and frozen. Pretty self-explanatory. Yeah. Branded foods that need to be kept cold or frozen. Again, mostly U.S. retail. Think Bird's Eye, Healthy Choice, Marie Callender's frozen meals.
Got it.
Third is international. That's basically all their branded food products could be frozen, shelf-stable, whatever, sold outside the United States, both retail and food service channels.
So same kinds of brands, but just, abroad.
Generally, yeah.
Yeah.
And finally, there's food service. This is different. It's branded and customized food products. Meals, sauces, entrees specifically packaged for restaurants, cafeterias, hospitals, that kind of thing, mostly in the U.S.
Okay, that makes sense. Breaking it down like that seems necessary for a company that big. Now let's get into the financials. This is where it gets really interesting, I think. Looking at their recent numbers, fiscal 2025. Overall net sales were $11.6 billion. That's actually down from fiscal 2024, which was just over $12 billion.
Yeah, a noticeable dip.
And they note that this decrease came from organic decreases pretty much across the board in their segments, except, interestingly, the international segment actually grew.
But then you look at diluted earnings per share, the EPS. And that tells a completely different story. It jumped significantly, up to $2.40 in fiscal 2025 from only $0.72 the year before.
Whoa, okay. Sales down, but profit per share way up. That seems counterintuitive. How does that happen? What's driving that huge jump in net income and EPS when sales were lower?
Right. That's the immediate question. And it points to something specific, not just better operating margins across the board. A major driver was a massive drop in their income tax expense. In fiscal 2024, they paid about $262.5 million in income tax. In fiscal 2025, it was just $3.7 million.
Wow. From over $260 million down to less than $4 million? How?
Okay, so the reason was this specific $225.8 million tax benefit they recorded in fiscal 2025 came from settling a federal audit. And this settlement allowed them to release what are called valuation allowances on some deferred tax assets.
Valuation allowances? Deferred tax assets. Can you unpack that a bit?
Sure. Think of deferred tax assets like potential future tax deductions the companies has built up, maybe from past losses or certain expenses. A valuation allowance is like an accounting reserve they set up against those assets. If they're not sure they'll actually be able to use those deductions in the future, maybe they don't expect enough future profit to offset.
Mm-hmm.
So this audit settlement basically gave them the green light. They confirmed they could use those deductions. So they got to reverse that allowance, take it off the books, and boom, that reversal flows straight through as a massive reduction in their tax expense for the year, which dramatically boosts net income and EPS.
Ah, okay. So it's a big positive number on the income statement, but it's really an accounting adjustment based on past stuff and an audit outcome, not necessarily because they sold way more product or cut operational costs drastically this year.
Exactly. It's a significant event, but it's more of a one-time thing related to taxes, not a reflection of improved core operating performance in that specific period. You have to look past that big jump to see the underlying trends.
That's a really important distinction for anyone looking at these numbers. Okay, so what about cash flow? Like the actual cash generated by the business operations?
Right. Cash flow from operating activities gives a different picture. That actually decreased. It went from about $2.02 billion in fiscal 2024 down to $1.69 billion in fiscal 2025.
Okay, so less cash coming in from the day-to-day business. Why was that?
Well, a few things played into it. Lower operating profits, which makes sense given the lower sales. They also got lower dividends from an equity investment they hold. And they had higher inventory balances, meaning more cash tied up in stock. On the plus side, they did get a boost of about $140 million from accelerated receivables. Basically, some customers paid them faster than usual.
Got it. So cash flow down, reflecting some of those operational headwinds, despite the big accounting boost to net income. What about debt? Big companies usually carry a fair bit.
They do. As of May 25, 2025, their total long-term debt, the face value, was about $7.29 billion. And for a company like Conagra, maintaining investment-grade credit ratings is really crucial. It affects how much it costs them to borrow money and whether they can easily tap into capital markets when they need to. A downgrade makes everything more expensive.
Makes sense. And what about shareholders? Are they getting dividends, buybacks?
Yep. They authorized a quarterly dividend of $0.35 per share, which was paid in May 2025, and they declared another one for August 2025. So steady returns there. Plus, they still had authorization to repurchase about $852.6 million worth of their own shares as of late May 2025. Gives them flexibility to do buybacks later, which is another way to return value.
Okay, so that paints the financial picture. Now let's connect this back to the real world. What are the big challenges, the operational realities Conagra is dealing with every day? You mentioned the food industry is competitive. That's got to be a huge factor.
Oh, absolutely. It's fiercely competitive. They're constantly battling for shelf space, for consumer attention, and some of their competitors are genuinely larger companies with even deeper pockets, more resources.
And relationships with retailers must be key.
Huge. And what's really striking here is the influence of their single largest customer, Walmart and its affiliates. In fiscal 2025, Walmart accounted for roughly 29%, almost a third of Conagra's total net sales.
29% from one customer.
Wow.
Yeah.
So when you see consolidation happening among retailers, big chains getting bigger, that directly impacts Conagra's negotiating power. Large retailers can push hard on pricing, demand more promotions. It puts real pressure on margins.
I bet. And besides customers, what about the cost of just making the food? Ingredients, packaging?
That's another constant battle. Raw material and packaging costs are incredibly volatile. And the things that influence those prices, it's like everything. Global economic conditions, tariffs, trade barriers, obviously supply chain snags like we've seen recently, but also weather droughts, floods affecting crops, even animal diseases like avian flu hitting poultry supplies and prices. It's a huge range of factors.
So how do they even manage that uncertainty?
They try to mitigate it.
Yeah.
Partly through finding internal efficiencies, productivity improvements, partly through pricing initiatives, passing costs on where they can. And they also use financial tools, derivative instruments, basically hedging. They might lock in a price today for, say, corn or oil they know they'll need 6 months from now. It's like buying insurance against price spikes.
Right, trying to bring some predictability to it all. And then there's seasonality too, right? People buy different foods at different times of the year.
Definitely. Simple examples. Their frozen food sales are usually a bit higher in the winter months. Makes sense. And pie sales, like Marie Callender's pies, they see a big peak in November and December, Thanksgiving, Christmas.
Of course. Holiday baking season. It's funny how those simple consumer habits ripple all the way up to a multi-billion-dollar company's financials.
It really does. And managing all this, the competition, the cost, the seasonality, leads to another big strategic challenge. managing the brands themselves, especially when market tastes shift or the economy changes. This really came through in their recent financials. They recorded significant brand intangible impairments in fiscal 2025, about $72.1 million worth.
Impairments, so write down.
Exactly. They had to reduce the value of certain brands on their balance sheet. And this wasn't new. They had an even bigger impairment, like $430 million
Yeah.
in fiscal 2024. A lot of this related to brands they picked up in that big Pinnacle Foods acquisition a few years back. They specifically mentioned Bird's Eye and Earth Balance.
So what causes them to say, okay, this brand isn't worth what we thought?
It's usually a combination of things. Maybe the brand's sales or profit margins aren't hitting the targets they projected when they acquired it, or broader economic factors, like rising interest rates, can change the calculation of a brand's future value. Essentially, the expected future cash flow from the brand looks lower than before, so they have to adjust its carrying value on the books.
Okay, so it's literally them acknowledging, yeah, the value proposition here has changed. On the flip side of managing brand value, protecting their brands must be huge. Intellectual property, trademarks.
Absolutely critical. Conagra owns a ton of valuable trademarks. Slim Jim, Ready Whip, Hunt's, Healthy Choice, names people instantly recognize. But what's also kind of interesting is how they use licensing. It goes both ways. They license in names from others to put on their products like P.F. Chang's home menu items, Bertolli sauces, even Wendy's chili, and Libby's canned vegetables is another licensing deal.
Ah, so they make those products but under license.
Right. And then they also license out some of their own brands. Like they let other companies use the Alexia or Marie Callender's name on certain products. It's a way to extend the brand's reach into new categories without making everything themselves. Pretty dynamic.
Okay, so shifting gears a bit, let's talk about the physical side. Where do they actually make all this stuff? And the people involved, they must have a massive operational footprint.
Oh yeah, it's extensive. They operate 38 manufacturing plants just in the U.S., spread across loads of states: Arkansas, California, Illinois, Iowa, Ohio, Pennsylvania, many others. Plus they have international plants in Canada and Mexico. And then, of course, all the necessary offices and distribution centers to support that network. It's a huge logistical operation.
And are they investing in keeping those operations up to date? Technology, automation?
Definitely. They specifically mentioned they're committing to investments in automation, connected data systems, better equipment, even using artificial intelligence. The goal is to upgrade their operations, boost productivity, become more efficient. Though they do acknowledge that these big tech upgrades can sometimes temporarily increase costs or even slightly reduce production while everything's being installed and integrated. Short-term pain for long-term gain, hopefully.
Makes sense. And in today's world, you can't talk about operations in tech without talking about cybersecurity. How are they handling that?
That's another area where they seem pretty robust. What really stands out is the expertise they highlight. They have a Chief Information Security Officer, a CISO, who apparently has over 25 years of experience and a Doctor of Science degree specifically in cybersecurity.
Wow, okay. That's serious expertise.
Yeah. And they state their cybersecurity program isn't just siloed in the IT department. It's integrated into their overall enterprise risk management framework. That means the board of directors and its audit and finance committee have direct oversight. It shows they're treating cyber risk as a fundamental business risk, right up there with supply chain or financial risks.
Good to hear. Okay, so let's move from the machines and data to the people, their human capital. How many employees are we talking about?
As of May 2025, they had about 18,300 employees. And an interesting point is that around 44% of those employees are covered by collective bargaining agreements, union contracts. They do note that they believe their relationships with employees and the unions are good.
That's a significant chunk of the workforce under union contracts. How do they describe their overall company culture?
They frame it around 6 core values they call timeless. Things like integrity, external focus on the customer, competitor, broad-mindedness, agility, leadership, and results. They position these values as the sort of framework for how they manage people, how they expect employees to operate, aiming for both ethical behavior and high performance.
And what about keeping those 18,000 people safe, especially in manufacturing environments?
They provide some specific data on that. Their OSHA incident rate, that's a standard safety metric, was 1.32 incidents per 100 full-time workers in fiscal 2025.
Yeah.
What's notable is they say this rate has been below the industry average for the last 3 fiscal years. And crucially, they reported 0 workplace fatalities in fiscal 2023, 2024, and 2025.
That's a strong safety record. Good. What about attracting and keeping good people? Development, engagement?
They talk about strategies for that. They have something called the Conagra Promise, aimed at helping employees reach their full potential. And one specific program they mention is Invest in You. It actually encourages employees to carve out at least 1 hour per week just for learning and development activities.
An hour a week? That's a pretty tangible commitment to employee growth.
Yeah, it is. And another piece of their engagement strategy seems to be their employee resource groups, or ERGs. They have 8 of them, led by employees. Examples include an Asian Urge, an LGBTQ plus ally erg, a veterans urge, and others. The idea is these groups help foster an inclusive culture, give people a voice, offer support, networking, professional development, and ways to connect with the community.
Sounds like solid structure for internal community building. And I assume they offer the standard competitive compensation and benefits package too.
Right. I mentioned competitive pay, equity-based compensation for some employees, healthcare, mental health support, which is increasingly important, uh, adoption assistance, a 401k plan, family leave, paid time off, the whole suite you'd expect from a large corporation trying to attract and retain talent.
Okay. And who's leading all this? The executive team.
Yeah, they emphasize an experienced leadership team. For instance, Sean M. Connolly, the president and CEO since 2015. His background is deep in consumer packaged goods. He came from Hilscher Brands, before that Sara Lee, Campbell Soup, even Procter& Gamble way back. So lots of relevant industry experience at the very top.
Okay, so quite a journey we've taken there. As we wrap up this deep dive, we've really unpacked Conagra Brands from its beginnings over a century ago as a flour mill to now being this focused, pure play, branded food giant. We've looked at their financials, the nuance of sales being down, but EPS jumping due to that big tax benefit. We saw the cash flow pressures. We dug into the risks, intense competition, the huge reliance on Walmart, the constant volatility in costs and how they manage brand value, including those significant impairments. And we also looked inside the operations, the vast manufacturing footprint, their investments in tech and automation, the focus on cybersecurity, and their whole approach to human capital. Safety, development, inclusion, the ERGs. It paints a picture of a company that's definitely resilient, constantly trying to adapt, balancing these iconic old brands with the need for innovation and smart investments to stay competitive.
Absolutely. It's a complex balancing act. And maybe that leaves us with a final thought for you, the listener. Yeah. Think about how your own choices in the grocery store aisle, the brands you pick, even how you engage with food trends online, how that directly ripples back and influences the big strategic bets, the financial performance, maybe even the internal culture of these huge food companies like Conagra. What does that really imply about the collective power we have as consumers in shaping where the entire food industry goes next? It's a pretty powerful connection when you think about it that way, isn't it?